Hey, welcome back to MarketSnap. Hope your June is off to a solid start. Let's talk about what's happening right now. Earnings season is still in full swing. We've got roughly 445 companies reporting this week or next. That's a lot of noise to sift through. And with AI-related capex still dominating headlines, rates staying stubborn, and a quiet rotation out of mega-cap momentum into some beaten-down names, it feels like the market is trying to figure out its next move. Honestly, the action has been split. Some stocks are getting crushed for no fundamental reason, while others are flying on hype. That's actually where the opportunity is. So here's what I've been doing. I went through our valuation model and pulled out 5 stocks, 5 completely different setups. We've got one name our model sees as meaningfully undervalued, a massive gap between the current price and what the business is actually worth. Then there's an AI memory cycle winner with huge momentum and serious cyclicality. Plus, one momentum name the market is actively repricing higher. And then an oversold quality name. The metrics look fine, but the stock has been thrown out. Finally, one earnings catalyst name reporting soon that long-term investors should track. 5 different reasons to be interested. None of them are the same story. Before we jump into the names, a quick bit of context for June. The macro picture is mixed. AI-related spending is still the engine, but some industrials and consumer names are showing cracks. Meanwhile, valuations are stretched in a few pockets, but we're also seeing real value in others. That's the kind of environment where a stock-by-stock approach makes sense, not just buying the index and hoping. If you want to run these numbers yourself, our stock screener is a great place to start. It's free, and it's how I built this list. All right, first up is one name our valuation model sees as meaningfully undervalued. Let's get into it. So, Alibaba, ticker BABA. This is the Chinese e-commerce and cloud giant that powers a huge chunk of online shopping in Asia and beyond. And let me tell you, when I plugged this one into our model, I had to look twice at what came back. Honestly, the first version of the gap between where it trades today and where the model could see it going was massive. So here's what jumped out at me. Picture this. Today, Alibaba shares are trading at $131. In a more optimistic re-rating case, our MarketSnap fair value over the next 5 years can reach around $460. That implies a base annual growth rate of 28.58%. So if you put $10,000 in today, that upside case says it could grow to $35,142 in 5 years. Now that kind of upside is rare, so we need to understand why, and more importantly, what assumptions need to be true. Alibaba is interesting because it creates one of the clearest valuation questions in the market right now. Is this stock genuinely undervalued, or is the low valuation exactly what investors should expect from a Chinese tech stock? That distinction matters a lot. If you use a more conservative target PE ratio of 15 and a more realistic free cash flow path based on recent history, the blended MarketSnap value comes in around $133. The forward PE value is closer to $147. So under that more conservative setup, Alibaba is not wildly undervalued. It is trading roughly around fair value. But that is only one side of the story. The other side is the re-rating case. If the market starts giving Chinese tech stocks more respect again, and Alibaba gets even a modest expansion in its valuation multiple, then the upside picture changes completely. This is where the bigger model gap comes from. If investors become willing to pay a higher multiple for Alibaba's earnings and AI cloud growth, the stock could look dramatically undervalued from today's price. So this is really a 2-outcome story. In the conservative case, the China discount stays. Alibaba keeps trading at low PE ratios. Cash flow remains volatile because of heavy AI and cloud spending, and the stock does not move far from today's fair value range. In the upside case, the market starts to believe in the AI and cloud transition, the China discount narrows, and the valuation multiple expands. That is where Alibaba becomes much more interesting. Alibaba's revenue hit just over 1 trillion yuan in fiscal 2026. That is a lot of commerce flowing through their platforms. But here is the weird part. Their free cash flow actually turned negative this past year, at negative 50 billion yuan. That is a red flag on the surface, but the reason is they are spending heavily on AI and cloud infrastructure. They just announced a $56 billion investment over 3 years in cloud and AI capex. And that AI bet is real. Their new Qwen 3.7 Max model can run autonomously for 35 hours. They also unveiled a domestically built AI chip designed to compete with NVIDIA. This is a company that is not just defending its e-commerce turf. It is attempting to leapfrog into the next era of tech. The catch is China risk, geopolitical tensions, regulatory uncertainty, and the fact that the stock is down over 17% in the last 6 months. That kind of volatility is not for everyone. My take, the valuation gap here depends almost entirely on what kind of multiple the market is willing to pay for Alibaba in the future. Under a conservative China discount case, the stock is much closer to fair value around today's price. But if sentiment toward Chinese tech improves and Alibaba proves the AI and cloud investment cycle can translate into stronger earnings and cash flow, the upside case becomes much more interesting. That is the real tension here. The business is not broken, but the market may keep discounting it for a long time. So for me, BABA is not a simple cheap stock story. It is a bet on whether Chinese tech earns more respect from investors again. Keep Alibaba Group Holding Limited on your watch list if you want to track whether the AI transformation story starts to overcome the China discount. Stock number 2, Micron Technology Inc., ticker MU. So this one caught my eye because it's been on an absolute tear. I mean, up 96% in just the last month. That got my attention. So let me break down why it's on the list this month. Here's the valuation picture. Today, the stock is trading at $1,064. Our MarketSnap fair value 5 years out sits at $1,141. That gives us a base annual growth rate of 1.41%. So if you put $10,000 in today, our model sees that growing to $10,724 in 5 years. Not a huge gap between price and fair value. They are practically kissing distance apart. That's unusual for a stock that has rallied this hard. Now here's what jumped out at me about the business. Revenue last fiscal year came in at $37.4 billion. That's up almost 49% from the year before. And get this, operating income was $9.9 billion. Operating margin, 48.5%. That's not a typo. For a memory chip company, those margins are incredible. Return on equity sits at 40.8%. Return on invested capital at 27.7%. This company prints money when demand is strong. Free cash flow hit $17.5 billion last year. That's enormous. But the weird part is the valuation multiples. Trailing PE ratio is over 45. Price to sales is almost 19. That's expensive by any standard. And the stock has gained 344% in 6 months. Seriously, the question is whether the business can grow into that valuation. The catch is semiconductor cyclicality. Micron lost money in 2023, $5.8 billion in net losses. Memory chips are boom and bust, always have been. Plus, the stock is flashing some extreme overbought signals. One analyst called it a crash signal not seen in over 30 years. That's worth paying attention to. My take. Micron is a cyclical AI winner caught in a hype cycle. The business fundamentals are genuinely strong, elite margins, fantastic returns on capital, and a leadership position in high-bandwidth memory for AI servers. That's real, but the price trajectory over the last 6 months has been parabolic. At $1,064, the stock is already priced for a lot of good news. Our fair value at $1,141 suggests limited upside from here. If earnings do not deliver, the downside could be painful. Keep Micron Technology Inc. on your watch list for the next memory cycle update. All right, next up, Dell Technologies. Ticker DELL. And I have to be honest with you, this one jumped off the page at me. The price action here is just wild. We're looking at a stock that's up over 100% in the last month alone, more than 200% in the last 3 months, and almost 290% over the past year. So you're probably wondering, what is going on here? Let me walk you through the valuation picture. Today's price is around $435. Our MarketSnap value comes in closer to $342. The forward PE model points to about $359, while the DCF model is lower, around $295. So this is not a case where the model is chasing the stock higher. The model is saying the stock has already run well ahead of fair value. That means the MarketSnap downside is around 21% from the current price, and the DCF downside is closer to 32%. So yes, the momentum is real, but the valuation risk is real too. But here's the thing. The business momentum is also real. Dell just crushed earnings last week. Revenue hit $113.5 billion in their latest fiscal year, up from $95.6 billion the year before. That's nearly 19% growth. And net income came in at $5.9 billion compared to $4.6 billion the prior year. Earnings per share, $8.96 versus $6.51. So the business is growing. The AI build-out is driving demand for their servers and infrastructure. The quality picture is better than it first looked too. On the latest setup, return on invested capital sits around 18.5%, and the model rates financial quality as excellent. Forward EPS is around $17.95, and the current forward PE ratio is about 24.3 times. That is not crazy for a company tied to AI infrastructure, but the target multiple I used is closer to 20 times, which is why the fair value sits below the current share price. The weird part is still the balance sheet. Total debt is high, and stockholders' equity is negative, so there is real leverage here. The PB ratio is negative because of that equity structure, which makes book value metrics less useful for Dell. This is a cash flow and earnings story, not a clean balance sheet story. But the market does not seem to care right now. The stock doubled in 8 days. It's on track for one of its strongest runs in years. So what's the catch? When a stock goes up this far this fast, valuation gets stretched. Even if the AI server story is real, a lot of future growth is already priced in. Analysts are estimating earnings around $17.95, but at today's price, the stock is still trading above the level our model considers fair under a 20 times forward PE assumption. And with leverage in the background, any hiccup in cash flow or any slowdown in AI infrastructure demand could hit the stock hard. My take: I get the excitement around Dell. The AI build-out is real, and they are a major player in infrastructure. But this price move feels like it has gotten ahead of the fundamentals. When the MarketSnap value is around $342 and the stock is trading around $435, that's a yellow flag for me. The momentum could keep going. Momentum stocks can do crazy things. But the risk here is that a single earnings miss, a margin disappointment, or any slowdown in AI spending could trigger a serious pullback. The story is interesting, but the price makes me nervous. For this setup to get cleaner, I would want to see earnings keep surprising to the upside, or the share price cool down closer to the model's fair value range. Keep Dell Technologies Inc. on your watch list, but be aware that this is a momentum setup with real valuation risk. Stock number 4, Intuit Inc., ticker INTU. You probably know the name even if you've never owned the stock. TurboTax, QuickBooks, Credit Karma. They basically run the financial operating system for millions of small businesses and individuals in the US. And right now, this stock has been absolutely wrecked, down over 50% in the last 6 months alone. That's brutal. But here's the thing, the business itself, still generating massive cash flow, still growing revenue. So what gives? Let me walk you through the valuation because this is where it gets interesting. Today, Intuit is trading at $322 a share. Our MarketSnap fair value looking out 5 years? That's $532. Big gap. The base annual growth rate over that period comes in at 10.54%. So picture this. You put $10,000 into Intuit today. Our model says that could grow to $16,504 in 5 years. That's not a guess. That's the math on current fundamentals. Now here's what jumped out at me from the data. Revenue last fiscal year hit $18.8 billion. That's up 15.5% from the prior year. Net income, $3.9 billion. Free cash flow was over $6 billion. I had to look twice at that. $6.1 billion in free cash flow on $18.8 billion in revenue. That's a cash flow margin north of 30%. For a software company that's already massive, that's rare. The weird part is the stock has been hammered by concerns over AI disruption and a Goldman Sachs downgrade to sell. Plus, there are investor lawsuits floating around over pricing issues. That stuff creates noise. But look at the fundamentals. Return on equity is over 23%. Return on invested capital over 16%. Debt to equity is just 33%. This is not a broken business. The catch? Execution risk is real. TurboTax faces do-it-yourself pressure from free competitors, and when the market decides to hate a stock, it can stay hated for a while. Intuit is down nearly 58% over the last year. That's a lot of pain. My take: Intuit is the kind of name that looks scary when everyone hates it, but the cash flow tells a different story. $6 billion in free cash flow on a stock that's down 60% from its high. That math eventually matters. The question is whether AI really threatens their moat or actually expands it. I lean toward the latter. TurboTax Live and Enterprise Suite are growing double digits. That's not a dying business. Is it oversold right now? I think so. But for the setup to get cleaner, I would want to see the selling pressure fade and the next earnings confirm the trend is intact. The valuation gap is wide enough to be interesting. Just be mindful that the stock is still under pressure. Keep Intuit Inc. on your watch list for a potential turnaround as the AI disruption fears prove overblown. Stock number 5, Adobe Inc., ticker ADBE. So, Adobe Inc., ticker ADBE. You probably know it for Photoshop, PDFs, and creativity software. But why is it on our radar this month? Simple. Adobe reports earnings on June 11. That's just around the corner. And when I looked at the numbers, I had to stop and double check. Let's talk valuation first, because honestly, the setup here is interesting. Today, Adobe sits around $262 per share. Our forward PE model comes in almost exactly around today's price at about $265. But the DCF model is much higher, around $556. Blending those together, our MarketSnap fair value comes in around $416. That is still a big spread, but it is important to understand where it comes from. The PE model is basically saying Adobe is close to fair value today. The DCF model is saying the long-term cash flow is worth a lot more if the business keeps compounding. The base annual growth rate our model projects is still attractive. So picture this. If you put $10,000 into Adobe today, our model sees a meaningful upside path over 5 years, mainly because of the cash flow side of the valuation. Not bad for a company that's been around since 1982. Now the fundamentals. Revenue last fiscal year was around $23.8 billion. That's up over 10% from the prior year. Free cash flow, almost $9.9 billion. That's massive. Net income came in at $7.1 billion. So this isn't some startup burning cash. It's a cash-generating machine. But here's the weird part. The stock is down almost 1 over 6 months and over 36% over 1 year. Why? The market has been punishing legacy software names. Fear around AI disrupting subscriptions, maybe. But look at the numbers. Revenue growth is still happening. Margins are fat. Forward EPS is around $23.33, and the forward PE ratio is only about 11 times. Current PE is around 14.7 times, which is low compared with Adobe's own history. And with earnings coming up, analysts expect EPS of $5.83 this quarter. Revenue estimate is around $6.5 billion. So the bar is set. The catch? Adobe faces competition from newer tools like Figma. Some investors worry that AI assistants like Firefly could cannibalize traditional subscriptions. And the stock's 200-day moving average is around $303, well above today's $262. So the price trajectory needs to reclaim that level to build momentum. My take: Adobe is one of those rare names where the business looks solid, but the market is already treating it like growth is permanently impaired. I see a profitable company growing revenue around 10%, generating nearly $10 billion in free cash flow, and trading at a low multiple compared with its own history. The PE model does not show much upside from here, but the DCF tells a different story because Adobe's cash generation is still extremely strong. That is the tension. The upcoming earnings report will tell us if AI is actually helping or hurting demand. If they beat estimates and guide higher, this gap between the market price and the blended MarketSnap value could start to close. If they miss, the 52-week low near 2.24 becomes the level everyone will be watching. Either way, the setup is worth tracking closely. Keep Adobe Inc. on your watch list for earnings on June 11th. That print could be the catalyst. That wraps up our 5 stocks to check for June 2026. Here's a quick recap of what we covered. We started with Alibaba Group Holding. Our model sees a pretty big valuation gap there, so it's worth keeping an eye on. Then we looked at Micron Technology, an AI memory cycle winner with powerful momentum, but also real cyclicality. Next up was Dell Technologies. That stock is a momentum name, and the tape is definitely repricing it higher. I had to look twice at the move. After that, we talked about Intuit. It's a quality business that got oversold after a sharp pullback. That dip caught my attention. And finally, Adobe. They have an earnings catalyst coming up this month, so it's a big event to watch. Remember, this is just a watch list, not financial advice. Always do your own research, and if you want to dig deeper, the MarketSnap screener, calculator, and investment outlook are all linked in the description below. Thanks for watching. See you next time.